Hi everyone, it's Jack back with another video, and today I'm going to be talking about Match Group, the parent company of Match.com, Tinder, which is obviously the biggest story here, Hinge, which has been growing absolutely fantastic, Plenty of Fish, and a ton of other dating websites that equate to around 70% market share of the North American dating market. Basically everything except Bumble and Grindr. Right now, it's around $10 billion market cap, trailing P ratio of just 16. So it surprised me a little that I don't really hear much about this stock, but the primary reason is it leaves a bitter taste in people's mouths because it's down nearly 80% in the last 3 years from its October 21 highs. Right in the middle of its 52-week range, there's been a bit of buzz about it recently. It's done okay in 2024, and that's because it recently announced that it's going to be doing some pretty aggressive allocation of capital, which I'm going to talk about later. That's going to be real positive for shareholders. But first I want to talk about the evolution of the group, where they stand in the market, the revenue growth right now, or the revenue story, the Tinder and Hinge story, and then talk about capital allocation, and finally valuation, which I think is really attractive right now. Match's strategy early on was obviously hard paywall, pay to communicate, etc. And that was effectively just with Match.com. Over time, they've grew mainly by acquisition, with acquisitions at relatively early stage of both Hinge and Tinder, and this has generated them to a more modern subscription pay for access, mobile first platforms. You sort of, well, particularly in the younger age bracket, most of the people who are using dating apps, you don't really hear much of Plenty of Fish, Match.com, OkCupid or whatever. Really the name of the game is Tinder, Hinge, Bumble and perhaps Grindr. Phase 3 and Phase 4 are really where we are now. Phase 4, I think there's a lot of investor relations stuff here, increased consumption of video live experiences, AI and AR driven experiences, not necessarily the investment case here for me. Match's portfolio can be broadly separated into how they categorise evergreen and emerging, would be Match, Meetic, OkCupid, Plenty of Fish, which are sort of the older, more legacy brands. They could turn evergreen, I would say legacy. They're not really evergreen in the sense that, yes, they still have users, but they're not exactly growing. And then the emerging brands, The League, BLK, Chispa and Archer, which have varying levels of success and have sort of been around 2015 to the present day. And the largest brands, which are obviously Tinder and Hinge. Hinge has the incredible growth rates and Tinder has the incredible revenues. These are the drivers of this business going forward. And when analysts are looking at this stock and covering this stock, they're going to be the things that's talked about, particularly Tinder. Before we get into Tinder and Hinge, let's just look at some overall numbers for this business. Total revenue, you look at it since 2019, fantastic trajectory, up around 60%, $3.3 billion in revenue in 2023 compared to just $2 billion in 2019. Of course, in the meantime, they were trading absolutely nosebleed valuations and have had to deal with user-wise and payer-wise some really tough comparisons, because you can imagine during the pandemic, the payers and usership numbers for this business were through the roof because that was all you could really do in the dating scene was use online apps. Whereas nowadays you can go back to normal essentially. I do think there is a significant tailwinds behind this becoming a long-term trend in dating apps. I think we're already really seeing it, increasingly online people. Adjusted operating income, one we're looking at on an adjusted basis compared to the regular basis, which tends to be a bit lumpy, the gap numbers. On an adjusted basis, typically between 35 and 38% operating margin, which is absolutely fantastic. Gross margin for this business are ridiculous. And that's almost doubled in the last 4 years, which is really impressive in my view. 38% operating income on nearly $1.3 billion in income. Really, really strong. Tinder is absolutely the crown jewel of Match Group. Its revenue since 2019 has grown at a compound annual growth rate of 14%. It's been a fantastic growth story for this business. Total direct revenue is just over $1.9 billion. That's more than 60% of the total revenue of this business, so it's absolutely the key story here. Gets the most attention from analysts, and it's probably part of the reason why the valuation for this company is going down, because Tinder has not just sprang up in 2019. It's been going for a while, and its ability to increase payers has really not increased that much. User numbers are down in the last couple of years, and since Q4 2022, where payers peaked, it's been coming down, so just shy of 10 million payers. In the most recent quarter, they had over that in Q4 2022. However, the revenue per payer has sharply increased, and this is where they're effectively getting in continued revenue. They're squeezing each payer for more, and then the payer numbers come down. How much pricing power will they have? Who knows? Tinder is the dominant app. They also have Hinge, which is growing rapidly. Can they continue to do this? It still is at a lower revenue per user than Bumble is, so maybe they have some pricing power to go. I believe they still have a little bit of pricing power, and I believe this is the right way to do it. Not everyone believes this, and really this and the Hinge story are really whether you're going to be a bull or bear on this, is can you get behind Tinder being able to have more pricing power with its users, which I believe they will. So while Tinder is the crown jewel, Hinge is really growing at the minute. Tinder is sort of becoming the legacy product. 14% compound annual growth rate over the last 5 years. It's absolutely nothing to sniff at, but it pales in comparison to the revenue growth rate that we're seeing at Hinge, which in fairness is in the early stages of its monetization. But its ability to increase revenue per payer, which is now getting on for $30, absolutely fantastic. The payees numbers are much smaller, they're just over 1.2 million payees. However, getting that revenue per user up is absolutely fantastic. You can see the compound annual growth rate for this is ridiculous. $31 million in 2019 in revenue, now $396 million. If they can keep growing in this 50% range, even in the 20 to 40% range, that'd be absolutely fantastic. And it can very quickly become a very serious part of this business. Right now, just over 10% of revenue compared to Tinder's 60%, but it's growing rapidly. Hinge is slowly starting to solidify its share of the market. Number one downloaded app in the majority of the English-speaking markets, UK, Australia, Ireland and Canada. Number 3 in the US after Bumble and Tinder. In some of the European countries, in the Nordics, France, Italy and Spain, it's having really strong placings, albeit behind some of the key leaders, but it is growing users at a much faster rate, and it's getting really strong traction here. And I do like its advertising campaign of designed to be deleted. It seems to be really working. What really got me interested in this business is their new capital allocation strategy. Currently, they're putting about $250 to $300 million in stock-based compensation every year. The most recent capital allocation strategy basically announced that they're looking to give 50% of their free cash flow to shareholders via share buybacks. This is only a $10 billion market cap company just below this, and that has 80% gross margins, 37% operating income. This has the potential to really be aggressively repurchasing shares and crushing the earnings per share expectations. They announced a new share repurchase authorization for $1 billion that replaced the current. They have no real capex needs. It's sort of a $50 million a year sort of thing. In 2023, they returned 66% of the free cash flow, exceeding the 50% margin. That was for $546 million of stock repurchased in 2023, an average of 31 a share. So a really nice price there. I can see if they continue this going forward, this could be a really nice business to hold. Earnings per share is going to go through the roof. And it's already trading at sort of 15 times trailing earnings. That's really cheap when you look at it from this angle. Right now, valuation-wise, it's trading around 16 times earnings, so even below the S&P 500 for a business that is definitely growing and has a really attractive margin profile. Of course, there are concerns over Tinder specifically not having as much pricing power as one may like. However, I think it has enough pricing power going forward. I think it will continue to trudge along in roughly the same pay numbers. Users may, go up and down. It's going to be lumpy, but I think they will be able to monetize these users better, more along the lines of Hinge and Bumble. It's currently trading at a price to cash flow around 10, so it's $1 billion in free cash flow, and it's able to use 50% of this for buybacks at least. This is really attractive to me. Its price forward earnings around 14, gives it a 6% earnings yield. I think this is a really nice position. It's far cheaper than the index, basically far cheaper than any other tech company I can find right now, and it's buying back shares at an aggressive rate. That's really the thesis for me. I expect Tinder to keep chugging along with single-digit earnings growth. I think Hinge is going to be it's gaining real momentum, having excellent monetization, much better than Tinder actually. I think we're going to be getting on for $1 billion of free cash flow this year, 250 of SBC, net 750 million possible for buybacks, probably going to be around 500 million, that 50% mark. Earnings per share for this company is going to fly up, plus single-digit organic growth going forward is sort of what I'm expecting. This is almost monopolistic market share. It's going to be really impressive for any sort of DCF you do on this company. I'd implore you to look at this business, do your own research and due diligence. I've started off with a small position. I'm hoping to grow it moving forward. Of course, this is just my opinion. Like I said, you should do your own research and due diligence. I'm not a financial advisor, so do your work yourself or speak to a registered financial advisor. Don't just take my opinion. Like and subscribe and enjoy the video. I'll see you again next time.